Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Much ink has been spilled on the fact that gains in the US equity market over the past 14 months have been driven only by a handful of stocks dubbed the Magnificent Seven. This has left the rest of the S&P 500 index constituents far behind in terms of their performance. The sector composition has also worked in favor of the US, resulting in its outperformance relative to other major global regions. The rise of information technology sector's weight in the US equity market indices has been a remarkable one. From 6% of the S&P 500 index in 1990, information technology sector reached a peak of 29% in 1999 during the dot-com bubble before declining to a trough of 15% in 2005. Thanks to the rise of Magnificent Seven, the IT sector weight stands at 30% again. It is not just the benchmark weight that has risen, investor positioning seems to have caught up too. For instance, the latest Bank of America Global Fund Manager survey showed that allocation to the US stocks is highest since November of 2021, and allocation to the IT sector is the highest since August of 2020. The survey also identified long Magnificent Seven as an extremely crowded trade. This heavy concentration of the US stock markets, the acute outperformance of the Magnificent Seven stocks, and the crowded positioning into these names all pose risks in the near term. Should the Magnificent Seven come under pressure due to idiosyncratic or sector-specific risks, the headline index will likely suffer too. One conceivable way to reduce the concentration risk in the US equity benchmarks and to benefit from a reversal of underperformance of the S&P 500 excluding Magnificent Seven stocks is to move to equal weighted indices from the market capitalization weighted versions. While the market capitalization weighted versions give higher weight to large cap companies, equal weighted indices have the same representation of all stocks, thereby reducing the dominance of Magnificent Seven stocks, which have super heavy representation at this stage. Over the past 20 years, both market cap weighted and equal weighted versions delivered similar returns, with the latter in fact marginally outperforming over that period. However, since the start of 2023, the market cap weighted index rose 31%, while equal weighted version rose only 13%. This underperformance is now starting to look extended and, in our view, poised to reverse over the coming months. Both versions of the S&P 500 index usually trade on similar valuations. However, the recent strong outperformance of the market cap weighted version has led to that index trading at a premium to the equal weighted version. Looking at the earnings growth differentials, such a valuation premium looks justified. However, it's worth noting that the earnings growth gap is now narrowing, and this should in turn allow the valuation levels to converge. The differences in index composition between the market cap weighted version and the equal weighted version are likely to work in favor of the latter in the months ahead. In the market cap weighted version, IT has a 30% weight, followed by financials, healthcare, and consumer discretionary, each having a share between 10 and 13%. The sector composition changes significantly in equal weighted version. The share of industrial sector rises to well over 15% compared to just over 8% in market cap weighted version. This sizable increase in the industrial sector representation works very well for us given our strong preference for that sector. Weight of real estate, utilities, and material sector is at least 3% higher in equal weighted version compared to the market cap weighted one. All these sectors are likely to work well when the interest rates start to come down in the US. Overall, moving from the market cap weighted S&P 500 index to equal weighted S&P 500 index reduces the concentration risk while still giving investors the much needed exposure to the US equity market. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on our investment strategies, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati signing off.